Assalamualaikum and salam sejahtera. I bid to Dr. Fahana. We are from Group 3 and we will present Part A and Part B of our topics. Before that, let me introduce to you our group members who are Farah Aisyah, Nurul Azira, me myself Nur Shafrina, Alif Haikal and Nurul Amanina.
Background of the case for Part B. In 1997, BASF Services Malaysia purchased property from PKNP under a purchase sale, development and infrastructure agreement. The contract included a purchase price, a development fee and an infrastructure fee, totaling approximately 170 million ringgit. When submitting the instrument for stamp duty, BASF declared only the purchase price and did not include the development or infrastructure fees. For the issue, the collector of stamp duties assessed stamp duty on the entire contractual sum, including development and infrastructure fee. This High Court partly sided with BASF, excluding the infrastructure fee. The Court of Appeal reversed this, holding that all fees were part of the consideration. The Federal Court confirmed that the total contractual consideration is subject to stamp duty. This case established that stamp duty applies to this instrument itself and all considerations stated within it.
Next, I will continue the presentation with the section and regulation related. The case Ketua Pengarah Hasil Dalam Negeri v. Eli Lilly Malaysia Sengkang Berhad 2009 concern whether business expenses are deductible under the Income Tax Act 1967. Eli Lilly claimed deductions for expenses related to medical seminars and promotional events. The DJIR rejected the claim, arguing the expenses were not wholly and exclusively for producing income. The court applied Section 33(1) and decided that expenses linked to business activities can be deductible even if they provide indirect benefits. This case highlights the importance of the wholly and exclusively tax in Malaysian tax law.
Next, I'll walk you through a critical tax law case that illustrates how judges interpret deductibility rules. This is Eli Lilly versus Director General of Inland Revenue, decided in 2010, a case that fundamentally shaped how we understand entertainment expenses under Malaysian tax law. The main question was straightforward but significant. Can a company deduct expenses for sponsoring doctors to attend a medical congress? Specifically, the costs cover food, travel and accommodation. On the surface, these expenses were incurred in producing income. The doctors were there to learn about and potentially promote the company's products. But the real debate whether this fell under Section 39(1)(I) of the Income Tax Act. Malaysian tax law uses a two-step framework. First, were the expenses wholly and exclusively incurred in producing income? Yes, they were. Second, even so, are they disallowed as entertainment? That's the critical question here. The judges had to decide, does sponsoring professional development count as business entertainment? Here's where it gets interesting. The court found that the expenses were entertainment under Section 18, specifically hospitality given without expectation of direct payment. But here's the key reasoning. Number one, the judges found no valid consideration. The doctors weren't contractually bound to buy anything. There was no quid pro quo. Number two is practical advantages like marketing exposure didn't convert this into a legitimate commercial exchange. Number three, referring to Bentley Stokes and Lourdes versus Bison, the court confirmed that entertainment means hospitality given without payment expectation. This distinguished the case from Aspect Lubricants, where promotional gifts were directly linked to purchases. Those had valid consideration. So the decision is Congress expenses classified as entertainment are not deductible under Section 39(1). The takeaway, marketing and professional development activities, when structured as free hospitality, fall into the entertainment category, and entertainment expenses simply don't qualify for deduction regardless of whether they generate income. And this case remains a landmark ruling for tax professionals navigating the fine line between deductible business expenses and prohibited entertainment.
Next, 1.4 Relevance to the scope of charge. In this section, I will explain the relevance of the Lili Malaysia Sendirian Berhad case to the scope of charge under the Income Tax Act 1967. The scope of charge refers to income that may lawfully be taxed under the Act. Under Section 3, income tax is imposed on income accruing in or derived from leisure. However, the actual tax liability does not depend on gross income, but on net income after allowable deductions are taken into account. Although the Lili case does not directly interpret Section 3, it is important because it affects how chargeable income is computed. The case highlights the significance of allowable deductions under Section 33(1) as the deductibility of expenses directly impacts the scope of charge. In this case, the Court of Appeal held that expenses incurred for overseas conventions were wholly and exclusively incurred in the production of income. As a result, these expenses were allowed as deductions under Section 33(1). The Court also rejected the Inland Revenue Board's argument that the expenses were entertainment expenditure under Section 39(1)(I). This decision prevented the artificial inflation of chargeable income and ensured that only real economic gain was taxed. It confirms the principle that income tax is imposed on net profits rather than gross receipts. From a legal perspective, the court adopted a purposive approach by focusing on the dominant purpose of the expenditure. This promotes fairness, certainty, and alignment with the economic reality of the taxpayer's business operations. In conclusion, although the Lili case does not directly define the scope of charge, it indirectly shapes it by confirming the tax applies only to genuine net income, and that costs incurred in generating income should not form part of the taxable base.
For background, Lili Malaysia conducted various sales promotion activities aimed at increasing their product sales. This included events, hospitality, and other promotional campaigns directed at healthcare professionals and dealers. The company claimed these expenses as deductible under Section 33 of the Income Tax Act 1967. However, the Inland Revenue Board disputed the claim, arguing that the costs were entertainment expenses which are subject to limited tax deductibility. The core issue was whether sales promotion expenses that include hospitality could be fully deducted for tax purposes. Lili argued that since the expenses were incurred to generate revenue, they should be deductible regardless of the hospitality components. The IRB claimed that such expenses were entertainment and should be limited. The court examined the substance over the form and focused on the economic purpose of the expense, which ultimately supported Lili's position.
Next, for the section and regulation related for the case Pemungut Duty Stamp v BASF Services Malaysia, Sendirian Berhad 2009 concerns whether certain agreements are subject to stamp duty under the Stamp Act 1949. BASF argued that the agreement were internal arrangements and not chargeable. However, the court applied Section 2 and held that a document is an instrument if it creates legal rights and obligations regardless of its label. Once classified as an instrument, Section 4 made it chargeable to stamp duty. The court also looked at the true nature of the transaction. This case confirmed that stamp duty depends on the substance, not the form of a document.
Next, I will explain a landmark stamp duty case that fundamentally changed how Malaysian courts classified instruments for taxation purposes. This is Pemungut Duty Stamp versus BASF Services Malaysia Sendirian Berhad, decided in 2009. which a case that established a critical principle. Stamp duty is a tax on instrument, not on the transactions behind them. Here's the fundamental distinction the judge made. Stamp duty doesn't tax your transaction or your business deal. It taxes the document itself, the piece of paper, the contract, the agreement. The duty falls on the legal instrument that creates, transfers, or evidences rights in law, not on what you're trying to achieve commercially. The court established a two-part rule for classification. Part 1 focus on the document's legal effect, not the party's commercial intentions. Part 2 look at what the instrument creates, transfers, or evidence in law. In other words, don't ask yourself what are these business partners trying to accomplish. What legal rights or obligation does this document establish? Step 1. Identify the instrument's true legal nature first. Step 2. Then match it to the correct charge under the Stamp Act's first schedule. This methodical approach prevents tax authorities from using vague interpretations based on the real transaction. There are 3 critical reasons. First, it prevents ad valorem assessment. Authorities can overreach by focusing on the commercial value of the real transaction behind the document. Second, it ensures stamp duty is based on the legal form of the document. This protects taxpayers from arbitrary reinterpretation. The third one is parties can look at the document and gauge exactly that stamp duty applies that don't have to guess the tax authority's interpretation. This ruling fundamentally shifted stamp duty assessment from being subjective and transaction focused to being objective and document focused. It is the principle that continues to guide Malaysian tax courts today. Understanding this distinction, instrument versus transaction, is essential for anyone dealing with stamp duty compliance. Thank you.
My name is Nurul Amanina Muhammad Ali, and I will be presenting Part B relevant to the scope of charge based on the case Pemungut Duty Stamp VBASS Service Malaysia Sindahan Berhad 2009. Let me start with a simple question. Can party reduce stamp duty just by changing the way payment are labelled in an agreement? This case gives us a very clear answer, which is no. Why this case matter? Because it clarifies how the scope of charge is determined under the Stamp Act 1949. The court confirmed that the stamp duty is a tax on the instrument, meaning the written document itself, not on the commercial intention behind the transaction. Moving on to the key principle, the court held that the stamp duty must be assessed based on the entire agreement, not selected part of it. Any payment expressly stated in the instrument form part of the chargeable consideration, regardless of the label used. In this case, the agreement states 3 payments: a purchase price of RM84,593,372 ringgit, a development fee of RM24,794,609 ringgit, and infrastructure fee of RM61,257,269 ringgit. First, the stamp duty was paid only on the purchase price, but the collector of stamp duty reassessed it using the total amount of RM170,645,250 ringgit. This is because the court agreed and decided that all these payments form one composite transaction. Therefore, this payment cannot be separate to reduce stamp duty. In terms of legal impact, this decision expand and clarify the scope of charge by ensuring the stamp duty is imposed on the full consideration state in the instrument. It also prevents artificial avoidance of stamp duty and promote certainty, consistency, and fairness in the stamp duty assessment. In conclusion, this case ensures that the stamp duty reflects the true legal effect of the document. Only what is written in the instrument governs the scope of charge.
I think that's all from us. Thank you and Assalamualaikum.